Okay, in this video, we're going to look at how to solve a capital budgeting problem and how to determine whether or not we should pursue a machine. So here's the problem. The Coyote Company is considering the purchase of a new 3D printer for use in its business. If the machine is purchased, it is expected to increase sales by $10,000 per year for the next 3 years, while also reducing pre-tax maintenance expenses by $4,000 per year. The machine will cost $30,000 to purchase today, and it will cost another $500 to ship and install in the facility. The machine will also require a one-time increase in net working capital of $1,000 at the time of purchase, which will be recaptured when the machine is sold. The machine is expected to fall within the maker's 3-year classification, with the rounded annual depreciation rates being 33%, 45%, 15%, and 7% per year respectively. At the end of 3 years, the Coyote Company expects to sell the machine for $3,000. Over the past year, the Coyote Company spent $700 evaluating various options related to this proposal. What are the annual expected cash flows for this project if the applicable tax rate is 35%? If the risk-adjusted cost of capital is 11%, what is the net present value, internal rate of return, modified internal rate of return, payback period, and discounted payback period for this project? Should the Coyote Company purchase the machine? So the final question we have here, should the Coyote Company purchase the machine? To answer that, we will want to review the capital budgeting criteria or assessment techniques, including the net present value, internal rate of return, modified internal rate of return, and the payback periods. But to get to that information, I have to first calculate cash flows. So let's go ahead and calculate the cash flows for this particular project. Now it's specified that we are to assume that this project is expected to increase sales by $10,000 per year for the next 3 years. So with that in mind, we have a 3-year project. So let's go ahead and put 3 years on our timeline. And now let's start with the cash flows that we have happening at time 0. So we have the initial cost, and the problem specifies that the initial cost is $30,000 to purchase today. So if we purchase it today, that's an outflow, so we'll put in a negative $30,000. Okay, so the next we have to look at the shipping and handling and installation and things like that. So note that the problem states that it will cost $30,000 to purchase and it will cost another $500 to ship and install in the facility. So if we look at shipping and handling and installation, which I will abbreviate, then that would be another negative $500 that's happening today if we pursue this project. Now the problem also specifies that the machine will require a one-time increase in net working capital of $1,000 at the time of purchase, which will be recaptured when the machine is sold. So if I have an increase in net working capital, an increase of net working capital is an outflow of cash. You can think of that as having to procure additional working capital or spending money to buy additional working capital. So in that case, we have an increase in net working capital. And our increase in net working capital is $1,000, and since it is an increase, it is an outflow. So we have that for time 0. Now that might lead us to review the rest of this information. So it's expected to increase sales by $10,000 per year, is reducing pre-tax maintenance expenses by $4,000. We've already accounted for the $30,000 today, accounted for the $500 to ship and handle it and install it. And then it's going to require this one-time increase in net working capital today. And we have depreciation information. Then Coyote Company is going to sell a machine after 3 years. And then it has this interesting little sentence here about over the past year, the Coyote Company spent $700 evaluating various options related to this proposal. So in that case, we have to think about this and determine what to do with that $700. So here's the key. Note that it says that over the past year, Coyote Company spent $700 evaluating various options. In that case, since the money has been spent in the past, if I pursue this particular project, that $700 has been spent. If I do not pursue this particular project, that $700 has still been spent because I spent it last year. And therefore, that $700 is not an incremental cost associated with this decision, because whether I pursue this project or I don't, that $700 is gone. Therefore, that $700 constitutes a sunk cost. So we will ignore the $700 altogether. Now, the next thing is to look at what we are going to have year by year. So first, what we're going to have is an increase in sales. So if I have an increase in sales, which are specified to be $10,000 per year, then we'll need to put in $10,000 for each year. And I can drag that over. Next, the problem specifies that we are going to be reducing pre-tax maintenance expenses by $4,000 per year. So we are going to have maintenance savings. And a penny saved is a penny earned. So if I am spending less on maintenance than I was before because I purchased this machinery, then that is a savings. So this $4,000 is a positive cash flow. Okay. Now, the next part is if we look through the rest of this, we have accounted for the $10,000, we have accounted for the $4,000, we have accounted for the $30,000, we have accounted for the $500, we've accounted for the $1,000. We haven't gotten to the depreciation yet, so let's talk about the depreciation. Depreciation is not a cash flow. However, depreciation does affect taxes, and if it affects taxes, it affects what I owe Uncle Sam, and therefore that is a cash flow, and thus I need to contemplate what's going on with depreciation. Even though depreciation itself isn't a cash flow, what it affects is a cash flow. So we need to come up with our depreciation. Now, if you notice here, it gives us these makers information. It says that this machinery is falling into the 3-year classification. MACRS stands for the Modified Accelerated Cost Recovery System. And we have a depreciation rate of 33%, 45%, 15%, and 7%, which of course add up to 100%. And those are the rates per year. So to find the depreciation for year 1, let's go ahead and put the rates over each year. Okay. So the depreciation rate for year 1 is 33%. And for year 2, it is 45%. And for year 3, it is 15%. And for year 4, it is 7%. Now you might be thinking, well, why do I have 4 depreciation percentages for a 3-year asset? Well, it's a little bit odd. The whole reason why Uncle Sam is allowing us to do the depreciation this way and with some acceleration here on the depreciation is to make the project look more attractive by allowing you to write off a larger portion of the value of the asset earlier in the project's life. Now, having said that, what strikes me as a little bit weird is that given that that is the objective for why the government is doing it, we didn't bother to just accelerate it just a little bit more so we just have everything fit neatly within 3 years. So that seems a little bit odd to me. But having said that, there is a little bit of logic behind this, and some of the logic here is the general assumption that you probably didn't actually start this piece of machinery exactly in at the beginning of the tax year, and so therefore if it lasts for 3 calendar years, it might actually span portions of 4 tax years. So there is a little bit of logic here, but it still does strike me as a little bit weird. But that's why we have 4 depreciation rates for a 3-year asset. And if you had a 5-year maker's asset, you would actually have 6 depreciation rates, and so on. So to find the depreciation, what we have to consider is what is the depreciable basis for this particular equipment. The depreciable basis would include the initial base cost, shipping and handling, installation, any modifications made to the equipment, everything that has to be done to the equipment to get it ready for use in our business. So in our case, that consists of this cost and the shipping, handling, and installation. So what we're going to do is we're going to take the sum of the cost and the shipping, handling, and installation, and we are then going to multiply it by our depreciation rate for the year. So if I look at that, I get a depreciation expense of $10,065. Not too bad. So then I tried dragging the formula. Well, that's not looking promising, but let's see why. Well, when I drag the formula over, I now am looking at the 45% for year 2. That's good. But unfortunately, I'm looking at these cells here instead of these. So what we need to do in this initial cell here is we need to make these absolute references so that when I drag the formula over, it keeps looking at these particular cells. So if I put my cursor here and I am working with a PC, F4 is the magic button that will put dollar signs on either side of the B and the 4. And the dollar signs fix the cell reference. So the dollar sign in front of the B fixes the column reference, so it's always going to look in column B. The dollar sign in front of the 4 says it's always going to look in row 4. So dollar sign B, dollar sign 4 says always look at cell B4. Then, if I do the same thing here, this is telling it to always look at this range from B4 to B5. Significantly, if I hit F4 repeatedly, I can actually cycle through different combinations of dollar signs. So if I wanted to fix the column, but not the row, I would do this. If I wanted to fix the row, but not the column, I would do that. And of course, if I want to fix both, I would have dollar signs in front of both. So if we have an absolute reference there now, and I drag this over, then lo and behold, that's doing what we wanted it to do. So that's good. That's exactly what we looked for. So at this point, we have now accounted for the increase in sales. We've accounted for the pre-tax maintenance expense savings. We have accounted for this $30,000 purchase today, the cost $500 to ship it, the $1,000 one-time effect on net working capital. We've incorporated some depreciation. And so now what we need to do is start looking at what's going to happen in terms of things like taxes. So let's go ahead and calculate a pre-tax figure. So kind of a pre-tax subtotal. So this is just going to be equal to the sum of these. So I'm going to sum my increased sales, my maintenance savings, and my depreciation to get the pre-tax subtotal. And I can then drag that over. And that's behaving nicely. To make this a little bit clearer, we could go ahead and add a boundary or a border below that. Okay, so that makes it a little bit clearer that we've done a summation here. So now that I have my pre-tax subtotal, we're going to incorporate our taxes. So the problem specifies that the applicable tax rate is 35%. So we're going to take equals negative 0.35 times my pre-tax subtotal. So this should take 35% of my pre-tax subtotal, make it negative, and we're going to drag that over. Okay. Now it's worth noting that if perchance I'd had a pre-tax subtotal that was negative, in other words, I was losing money pre-taxes, then I would actually get a tax benefit from that loss. And the tax figure would then show up as positive here. That is, of course, assuming that I have more than one project and I'm making money somewhere else in my business, and that therefore I would be offsetting the taxes I would be about to send Uncle Sam from that project due to the losses on this project. But in this case, we just have positive pre-tax subtotals, so all of our tax figures are in fact negative. So now we're going to do an after-tax subtotal. And so for our after-tax subtotal, that's just going to be the sum of the pre-tax and the tax. So sum of the pre-tax and the tax. And then I will drag that over to make sure this is nice and clear. Let's go ahead and add a summation border here. Now it's worth noting there's more than one way you can do this calculation, as is true for a lot of the capital budgeting scenarios. So I could actually have taxes show up as a positive number unless it's a tax savings, which would then be negative. And then I could essentially just do the subtraction here. Or what I have done is I've shown this is positive if it's an inflow, or kind of representing generally positive inflows, although the depreciation is not a cash flow, obviously. And then I have this giving us a negative when it's generally representing cash going out. And so from that standpoint, I just add the two. So I could reflect taxes as a positive and subtract the tax, or I reflect the tax as a negative and then I just add the two numbers. So you just have to pay attention to what you're attempting to accomplish and make sure that what you're calculating actually makes sense. For example, I'm showing that I have a pre-tax profit here. And if I have a pre-tax profit, I should be sending money to Uncle Sam, and therefore my after-tax number should be lower. So this is making sense. Well, now what we have to do is we have to correct for the depreciation adjustment we made. So specifically, up here, I deducted depreciation. But importantly, depreciation is a non-cash expense. So if it's a non-cash expense, the money hasn't actually gone anywhere. So I need to add it back in. So the easy way to do that is just to do equals and negative of this, assuming I have the depreciation expense showing as a negative up here. So if I do a negative of a negative, that's a positive, and I will just get the appropriate number here. And then I can drag that over. And that would get us to our next subtotal, which is going to be our operating cash flow. So to find our operating cash flow, we are going to sum those. So I sum the after-tax plus the depreciation add back. And I can drag that formula over as well. Okay. And for whatever reason, Excel is thinking that is a bad formula, but if we examine our formula, it's exactly what we want it to be, so it's fine. So we'll just go ahead and ignore that error. So again, let's go ahead and add a summation line here to make sure this is nice and clear. So I've added the after-tax subtotal plus the depreciation to get to the operating cash flow for each year. So now that I have the operating cash flow for each year, what we need to do is we need to account for some of the other things we have left over. Remember that it noted that for this particular machine, it would require a one-time increase in net working capital of $1,000 at the time of purchase, which is then going to be recaptured when the machine is sold. In other words, when we invested in this machine, we had an outlay of $1,000, perhaps to buy spare parts or something of that nature. And when I am done with the project at the end of 3 years, we're going to eliminate the machines. We're probably going to go into our factory, unhook it, haul it out, sell it to somebody for scrap. And when that happens, we no longer need to hang on to, say, the spare parts, or we no longer need to have the higher level of inventory, or perhaps we don't need to have as much cash, whatever the case may be for that increase in net working capital, so we can revert back to where we were before. So if we were going to revert back to where we were before, we will now have a decrease in net working capital in this particular case. Notice that we could have sort of an opposite scenario where I have a decrease here and then an increase later. But if I'm reversing and I had an increase initially, then I need to have a decrease here to reverse that. So to reverse it, I had a $1,000 outlay at time 0. So I'm just going to do equals negative of the negative 1,000. So negative of a negative is a positive. So that will reflect this as a positive $1,000 cash flow. Now, at the end of this project's life in year 3, what we're going to do is we're going to get rid of our machine, as I just mentioned. So when I sell a machine, that's called salvage. So let's take a look at how much I sell this machine for. So it specifies in the problem that at the end of 3 years, Coyote Company is going to sell the machine for $3,000. So we're going to sell it for $3,000. Now, when we sell that machine for $3,000, that brings up some interesting little challenges that we have here. Specifically, that when I sold it for $3,000, as you may recall from accounting and so forth, basically what we have to account for here is that when I sold it, it wasn't on my books for $3,000. So if I sold it for some amount other than what it was on my books for, then I need to account for whether I made a gain or a loss on the sale. But in order to determine the gain or loss on the sale, we need to know the book value of the equipment. Now in this case, and I'll go ahead and abbreviate for the sake of space. In this case, the book value that we're referring to actually is the accounting book value. So to find the accounting book value, you take cost less accumulated depreciation. So we'll take the sum of the overall cost, shipping, handling, installation, modifications, those things. Okay, so the things that I had to spend on getting this machine ready for use. And then I will subtract off the sum of the depreciation expense figures I have up here. So that would be cost less accumulated depreciation. Now, if I hit enter the way that I've written this, I will actually not get the right answer. The reason I won't get the right answer is because of the signs I've used for these other cells. These are already negative. Now, normally when you're calculating book value in accounting and you're calculating cost in the book value context, you reflect that as a positive number. So this part here needs to be a positive number. So to do that, we're just going to stick parentheses around it and a negative sign in front of the cost part. So if I take a negative of a negative, that's going to give me a positive. So it'll give me the positive cost less the sum of the depreciations. Well, the depreciations in this case are already negative. So normally when you're doing cost less accumulated depreciation, you are subtracting off these positive depreciation figures that you have perhaps on a balance sheet. Well, in our case, the depreciation is already negative. So if I do negative of a negative, it's going to turn into a positive set of depreciation numbers, which means I'm, in effect, going to be adding my depreciation to my original cost, which doesn't really make any sense. So I'm going to change that sign to a positive. So the net effect of this is I do still have cost less the accumulated depreciation over here. It's just I have a positive sign in the middle because the depreciation figures are already negative. So we're still doing cost less accumulated depreciation. That hasn't changed. And we get a book value of equipment of $2,135. Okay. Now, notice that since we're doing this with makers, we can actually kind of check this a little bit, because if we look at our percentages, there's one percentage we have not applied yet, and that's that 7% for year 4, which we didn't have a year 4. So if I think about this, at the end of year 3, my book value ought to be whatever I have not yet depreciated. Well, what I have not yet depreciated at the end of year 3 is this 7%. So one interesting thing to do is to check that, and let's go ahead and do equals 0.07 times the sum of our cost information. So I'll take the cost information times the 0.07, 7% for year 4. Let's put a negative sign in front of it to make sure that it accounts the fact these are all negative at the moment. And lo and behold, we got 2,135, which is the same number we got down here. So notice that I can actually kind of jump ahead if I'm using makers and find out by adding up any remaining year's depreciation figures. So any remaining year's depreciation figures that I haven't used yet, add up those percentages, apply that to the depreciable basis, and that will tell me what the book value is at the end of the preceding year. So we got the same number that we got down here, so that's good, kind of nice and comforting. All right, so now I'm going to calculate the gain or loss, which in this case I sold it for $3,000 and the book value was $2,135, so I definitely have a gain. So to find the gain, I'm going to take my salvage less the book value of the equipment. So salvage less the book value, so that gives us a gain of $865. Well, if I made a gain, Uncle Sam is going to show up and he wants his cut. So we're going to have taxes. And if you recall from the problem, the tax rate is 35%. So I'm going to take equals negative 0.35, so 35% times the gain, because Uncle Sam is going to tax me on the gain. And that will tell me that my taxes amount to $302.75. Now what I need to find is the cash flow from the sale, okay, which I'll abbreviate. So to find the cash flow from sale, I have to put together the pieces that I have here that involve cash. Let's go item by item, discuss whether they involve cash. Salvage. Does salvage involve cash? Yes. I sold the machine to somebody else. He may have taken it for scrap, or perhaps he's using it, but I sold it to somebody. He gave me a check for $3,000. In this case, that's cash. Book value. Book value is not cash. Book value is merely the value on the books of this piece of equipment. So this is a journal entry, so not cash, or more accurately, a balance sheet item. gain is the amount of money I made when I sold the equipment. So I sold the equipment for $3,000. I made a profit of $865 on the sale, but nobody gave me a check for $865. I did get a check for $3,000. So that $3,000 was cash. This gain is not cash. The gain is merely a way of tracking how much of what I sold the machine for was a profit. So this gain is not a cash flow. So we will ignore that. Taxes. Well, if I made a gain, I am going to have to pay Uncle Sam. If I had a loss, I could actually have a tax benefit, which would mean that, assuming that my company was making money elsewhere, if I had had a loss on the sale, it would mean that I was about to send Uncle Sam a little bit less in terms of taxes from other projects than I would have otherwise. And so since a penny saved is a penny earned, if I have a loss on the sale, my tax figure would actually be a positive number, but it would involve cash. So in that case, what actually involves cash in this transaction? Well, the salvage involves cash and the taxes involve cash. So those are the two that I have to put together in order to get the cash flow from sale. So we're going to take the salvage plus the taxes. Now in this case, I'm adding the taxes or tax cell, but the only reason I'm doing a plus sign here is because the number in the tax cell is already negative. So if we take a look at that, notice that I had $3,000 of cash flow from what I sold it for, but I had to send Uncle Sam about $303. So my cash flow from sale is a little less than $2,700. Okay. So there's more than one way that you can construct the signs associated with this example. Just make sure that the end result you get actually does make sense. So if I have a positive salvage figure and I have a gain on the sale and I'm owing money to Uncle Sam, then my cash flow from the sale should actually be a little bit less than my salvage value. If I had a scenario in which I lost money on the sale, then I could have a positive tax impact, meaning that my cash flow from sale could actually wind up being larger than the salvage value. Okay, so now what we need to do is we need to find the total cash flows. Okay, so our total cash flow for time 0, if I buy the machine right now, is just the sum of those. Those are the only things that I have going on at time 0. My total cash flow for year 1 is just this operating cash flow, so there's nothing exciting about that. And the same is true for year 2. For year 3, I have the operating cash flow, and I also have this decrease in net working capital, and I also have the cash flow from sales. So I have to incorporate all 3 of those in order to get the total cash flow for year 3. So now that I have a set of cash flows, I'll go ahead and ignore this error again. So I now have a set of cash flows. Let's kind of come back to the problem here. So the first part here is, what are the annual expected cash flows for this project if the applicable tax rate is 35%? Well, we have found the annual applicable cash flows. So we have that. If the risk-adjusted cost of capital is 11%, what is the net present value, internal rate of return, modified internal rate of return, payback period, and discounted payback period? So let's go ahead and calculate a few things here. So if we're dealing with, let's see here. We're dealing with first the net present value, and the cost of capital is 11%. So if our risk-adjusted cost of capital is 11%, and we're going to look at net present value and IRR and MIRR. So if you've been following along with the videos, then you should know what's coming next. So equals NPV, open parentheses, it asks for the rate, comma, and then value 1. So we highlight from 1 through the end, close parentheses, plus year 0 outside the parentheses. So that should give us our net present value. So $1,684.50, which is positive, and a positive net present value is something we like, so we're liking the project. To find the IRR, it's equals IRR, and then we're going to highlight all the values. And the IRR, as it turns out, is 13.98%. So if the IRR is 13.98% and our applicable cost of capital is 11%, we expect this project to get us a couple percent more than what we require normally, and therefore we like the project. So let's calculate the MIRR. So equals MIRR, and we're going to highlight all the values, comma. Now what's a finance rate, which is our risk-adjusted cost of capital, and a reinvestment rate, which, as we've discussed in the prior video, we're going to assume in this case that the reinvestment rate is the cost of capital that applies to the project. And the reason for that is because if we had a lot of really good projects that were available, we should already be doing them, which means the only projects that I haven't yet done are the projects which are offering a rate of return which is much closer to the risk-adjusted cost of capital that we were looking at. So that's why we're going to use a reinvestment assumption of the 11%. So when I hit enter, I should wind up with a number that's between the 11% risk-adjusted cost of capital and the approximately 14% IRR. So let's take a look. And I did. So the MIRR is 12.94%. So notice that the net present value is positive, so that means we like the project. The IRR is greater than the required rate of return of 11%, so we like the project. The MIRR is also greater than the required rate of return, so we like the project based on the MIRR as well. So we like the project. Now, the next thing that we have here is that we are going to need to find the payback period and the discount payback period for this particular project. So what we can actually do is we can sort of do a running total here a little bit, and then kind of find out kind of how well we do as time goes by. So if I look at the cumulative cash flow, what I'm going to have is where I started the year plus where I ended the year. So this is where I started the year. This is the cash flow for the year. So this is where I have ended year one. So at the end of year one, I still found myself in the hole by about $18,000, almost $19,000. So at the end of year two, since I started in the hole by $18,000, but then I earned almost $14,000, we're going to wind up ending year two in the hole by about $5,000. Well, if I started year three in the hole by $5,000 and I earned over $14,000, I'm going to end year three at a positive $9,925. So what that means then is that at the end of 2 full years, I still hadn't gotten all of my money back, okay? Because these are the cumulative cash flows. I still hadn't gotten all of my money back. So it took 2 full years, but it didn't take the full 3rd year, because by the time I got to the end of the 3rd year, I actually had some extra value left over here. So to find the payback, our payback then is going to be equal to the 2 full years that it took plus this amount that I still needed to earn in order to get back to 0, okay? So from that standpoint, what we're going to do is we're going to take 2 for the 2 full years plus the ratio of how much I needed to earn in order to get back to 0 divided by how much I actually did earn. So we're going to assume we earned the money in year 3 evenly throughout the year. Now notice that this is negative, so we have to watch that. So negative of this amount here divided by this amount, and then we'll close parentheses. So what that's going to tell us is that it took 2 full years plus some proportion of this 3rd year, again, assuming that I earned my money in year 3 evenly throughout the period. So if we hit enter, we get 2.35, which is not a dollar figure. Okay, so the payback is 2.35 years. Now, in order to do this for present values, or for the discounted payback, we have to have present values. So to find the present value, this cash flow is already at time 0, so I can just use that number. Now to find the present value, we're going to do equals PV, and the rate that we're going to use is our 11%, and we're going to use an absolute reference, so when I drag the cell over, it doesn't change. Now the number of periods I need to bring this back to get it to the present is actually the same as the number of years, because this is the 1st year. So I will connect it to that number of years. Payment would be if I had an annuity, which I do not have. Future value would be this number right here, okay? And now what we're going to do is we're going to find the present value of that first cash flow. Now, the way that Excel handles things is sort of like the way some calculators handle it, and that is even though I put in positive numbers that try to tell me that the present value is negative, And it's really not. So I'll go ahead and put a negative sign in there to correct that. Okay, so in that case, that looks pretty good. So I fixed the rate, so forth. So let's go ahead and drag that over and see how this works out. So in this case, I'm still connected to the same rate. That's good. And I'm connecting the proper number of periods. That's good. And I also have the future value. That's good. And we're finding present value. So this part's working. So I have my my wonderful present values here. So now what we're going to do is we're going to do the cumulative of the present values. So we're going to have this, where I started, which was in the hole by negative $31,500, plus what the present value is. So at the end of the first year, if I'm using present values to calculate how long it takes for me to get my money back, then in that case, I'm still in the hole by about $20,000 at the end of the first year. So to find out where I ended the second year, I'll take where I began the second year plus what I earned the second year in present value terms, and we wind up still in the hole by about $8,000, almost $9,000. So for the third year, I'm going to take where I started plus the present value that I earned over the course of that third year. Lo and behold, I got to payback. So our discounted payback, okay. So our discounted payback, notice that it did take a full 2 years plus some portion of the third. So our discounted payback is going to be equal to 2 plus some portion of the third. Well, at the end of the second year, I still needed to earn nearly $9,000. I earned over $10,000. So in order to find the discounted payback, what we're going to do is we're going to take negative of this to find the amount. Whoops. Helps if you have an equal sign. So now we're going to take our 2 years, because it took 2 full years, plus negative of this. And then we're going to divide that by this. So we're going to find the proportion of the cash flow, the present value of the cash flow in year 3 that we needed in order to get back to 0. So if we find that number, turns out is 2.84 years. So 2.84 years. Notice that is longer than the payback, which makes sense because I have ordinary looking cash flows. They're all, these future cash flows for years 1, 2, and 3 are all positive. Once I've discounted those cash flows, these numbers all got smaller. And since they all got smaller, it took me a longer period of time to get back to 0 if I'm accounting for this on the basis of present value. So my discounted payback is 2.84 years. My payback is 2.35 years. That is also consistent with what we have down here for net present value, IRR, and MIRR. Specifically, if I have achieved discounted payback here, when I've discounted the cash flows using the cost of capital, or the risk-adjusted cost of capital, then that would mean that I got back to 0 using present value. Well, that would mean that my net present value better be positive. So if I have a discounted payback, which means I actually got back to 0 before the end of the project's life, then my net present value should be positive, assuming we've calculated things correctly. It is possible to have a scenario in which the discounted payback doesn't exist, meaning that we haven't actually gotten our money back by the end of the project. And that can happen with payback as well, in which we just haven't gotten our money back by the end of the project. Now, if my discounted payback does not exist because I haven't gotten my money back, that would mean that the net present value should be negative, assuming we have nice ordinary positive cash flows for the future cash flows here. So it's possible to have a project that does not have a discounted payback because we never actually get our money back once we've accounted for time value of money, which would mean my net present value would be negative, which would mean it would be a bad project. However, even in that case, it is still possible to have a positive regular payback because regular payback ignores time value of money So if I ignore time value of money, sometimes it's possible the project actually gave us our money back. But once we've accounted for the fact that the money we got back was less valuable, we really kind of didn't wind up coming out ahead, which is why you can have a scenario in which discounted payback doesn't actually exist and the net present value is negative. But in this case, notice that our net present value is positive. Our IRR is higher than the risk-adjusted cost of capital. The MIRR is higher than the risk-adjusted cost of capital. And both our payback and discounted payback are less than the lifespan of the project. And we don't have any other information to compare those two. Sometimes companies will have standards for how fast they should get their money back. We don't have any other standards. So in the absence of any other standards for those two, our positive net present value in the IRR, which is higher than the risk-adjusted cost of capital, and the MIRR, which is higher than risk-adjusted cost of capital, that's all telling us that we should, in fact, pursue this particular project. So if we come back to this, we have found the net present value, the internal rate of return, the modified internal rate of return, the payback period, the discounted payback period. And then in answer to should the Coyote company purchase the machine, the answer to that is, well, since net present value is positive and the IRR is greater than the required rate of return or risk-adjusted cost of capital, and the MIRR is higher than the risk-adjusted cost of capital, and we get our money back before the project ends, yes, the Coyote company should purchase this machine because it is increasing shareholder wealth. And that is how you analyze a capital budgeting project.